We're down to the next segment of Chapter 12, which tackles about uncertainties leading to qualification of opinions. The International Standards of International Federation of Accountants specify qualification of opinions based on limitation of scope and disagreement with management as conditions that lead to an auditor's report containing a qualified or adverse opinion. So what is IFAC? It is a global organization for accounting profession that establishes and promotes international standards and speaks for the profession on public policy issues. Then what about the difference between a qualified and adverse opinion? So the former, or the qualified opinion, is issued if the auditor was unable to obtain sufficient evidence to verify the financial statement being audited, whereas the adverse opinion is given if the company's financial statements are misrepresented or misstated. In short, adverse opinion is a negative judgment from the auditor. Certain uncertainties may lead to an auditor's report containing a qualification of opinion. These uncertainties that we will discuss later on are material uncertainties, lack of consistency, independence of auditor, reports in reference to an expert, and fraud. I will only discuss the first two, as the remaining uncertainties will be discussed by the next presenter. Let's start first with materiality. Materiality is an essential consideration in determining the appropriate type of report for a given set of circumstances. Materiality is a concept that defines why and how certain issues are important for the company. How do we know if an item is material or not? An item is material if inclusion or exclusion of the item on the financial statement is sufficiently important to influence a decision made by the reasonable user of financial statements. If the amounts of a misstatement in the financial statement are so significant that the financial statements are materially affected as a whole, it is necessary to issue either a qualified or an adverse opinion depending on the nature of the misstatement. For instance, an inventory difference of 50,000 is material if the total inventory amount is 100,000. Because 50,000 is half the total amount and it is a huge portion to the inventory, so misstating such amount will have a significant impact to the financial statement as a whole. But if we change the inventory or the total amount of inventory to 10 million instead of 100,000, then that 50,000 will be deemed immaterial because it is only a small portion of the total amount. So it will not materially affect the financial statements. A material misstatement of the financial statements may arise from the following: inappropriate accounting policy selected, misapplication of selected accounting policy, and inappropriate or inadequate disclosure. When the auditor uncovers material misstatement, the auditor should inform the client of such misstatement and should insist that the financial statement be revised. If the management refuses to correct the misstatements, the auditor should express qualified or an adverse opinion. So as you can observe, the auditor does not immediately express their opinion after they have proven a material misstatement. They first communicate with their client and inform them of such misstatement, then ask them to correct it. If the management refuses, of course, as an auditor, it will raise suspicion that such misstatement was not an error, and rather, they are covering a fraudulent act. Because if the management has nothing to hide and such misstatement is purely unintentional, then they can easily revise it, right? So when they refuse to correct the misstatements, that's the time that the auditor will give a qualified or adverse opinion depending on the materiality of the misstatements. The next uncertainty that leads to qualification of opinions is the lack of consistency. We have already encountered the word consistency in our conceptual framework subject before, and as you can remember, it is one of the qualitative characteristics of accounting information. So just a brief review, consistency implies that once the management adopt an accounting policy or method, they should apply the same to the future accounting periods so that the results reported from each period are comparable. But that doesn't mean that the management are not allowed to change such principle or method. They can change it, but they have to disclose it in the financial statements, including the reason why they change from one principle to another. So why is lack of consistency an uncertainty? Lack of consistency in the application of accounting principles in the current period in relation to the preceding period may require a modification to an unqualified opinion. For instance, GAAP requires that changes in accounting principles or their application be adequately disclosed and that the audit report be modified by adding an explanatory paragraph that describes the nature of the change. A change in accounting principle is defined as a change from one principle to another principle when there are two generally accepted principles that apply or that a formerly used accounting principle is no longer generally accepted. If the auditor does not agree or approve the appropriateness of the change in accounting principle, then a qualified opinion will be given. That's the end of my report, and the remaining list of uncertainties will be discussed by the next presenter.
So good day everyone, my name is Ryan C. Viernes, and I'm going to continue the report of Miss Angela Bautista regarding the uncertainties leading to qualifications of opinions. So before I start, let us define again what is uncertainty. An uncertainty is a matter whose outcome depends on the future actions or events not under the direct control of the entity but that may affect the financial statements. The auditor should consider modifying the auditor's report by adding a paragraph if there is a significant uncertainty other than the going concern problem, the resolution of which is dependent upon future events and which may affect the financial statements. The international standards on auditing or the ISA do not require a qualified opinion or a disclaimer of opinion if the auditor is not independent. Although this is the case in several countries like Netherlands, which do not allow the auditor to accept the engagement in case he is not independent. So, the purpose of these international standards on auditing or the ISA is to establish standards and provide guidance under circumstances when the independent auditor's report should be modified and the form and the content of the modification to the auditor's report in those circumstances. And now let's proceed to the independent auditor's report. Accounting uncertainty impacts the auditor independence. Specifically, when accounting uncertainty did not exist, auditors maintained their independence by truthfully reporting the observed value. The auditors appeared to remain independent due to the concerns about the reputations with managers and investors. However, when accounting uncertainty existed, auditors impaired the independence by misreporting the observed value in favor of the manager. So, there are reporting responsibility. The first is single financial statements or on a specific element of financial statement. So, when the auditor undertakes an engagement report or on a single financial statement or on a specific element of financial statement in conjunction with engagement to the audit entity's complete set of financial statements, the auditor should express a separate opinion for each engagement. Next, the opinion of an entity's complete set of financial statement is modified. So the auditor should determine whether it is also necessary to modify the opinion or include an emphasis of matter or other matter paragraph on the report on specific elements of a financial statement. Next, the auditor has issued an adverse opinion or disclaimer of opinion on the entity's complete set of financial statement as a whole. PSA 705, or known as the Philippine Standards on Auditing 705, does not permit the auditor to include in the same auditor's report an unmodified opinion as this or on a single financial statement, as this would contradict the adverse or disclaimer of opinion on the entity's complete set of financial statements. Next, the auditor concludes that it is necessary to express an adverse opinion or disclaim an opinion on the entity's complete set of financial statements taken as a whole, but the auditor considered it appropriate to express an unmodified opinion on that element. The auditor shall only do so provided: first, not prohibited by law or regulation. The auditor is not prohibited by law or regulation from doing so. Next, not published together. The report on specific element is not published together with the auditor's report on the complete set of financial statements. And lastly, does not constitute a major portion, or the specific element does not constitute a major portion of the entity's complete set of financial statements. So, when reporting on summary financial statements, qualified opinions, emphasis of matter or other matters paragraph, when the auditor's report on the audited financial statements contains qualified opinion, emphasis of matter or other matter paragraph, but the auditor is satisfied that the summary financial statements are consistent in all material respects with the audited financial statements, the auditor shall state this fact on the report on summary of financial statements. Adverse opinion or a disclaimer opinion. When the auditor's report on the audited financial statement contains adverse opinion or a disclaimer opinion, the auditor's report on the summary financial statement should state the fact that an adverse or disclaimer opinion was issued on the audited financial statements, and as a result, it is inappropriate for the auditor to express an opinion on the summary of financial statement. The second topic or the second qualification of opinion is the reference to the expert. When expressing an unqualified opinion, the auditor generally should not refer to the work of an expert in his report because such reference might be misunderstood to be a qualification of the auditor's opinion or a division of responsibility. If the auditor, as a result of the other auditors or experts' works, issues an opinion other than unqualified, he may in some circumstances describe the work of the expert. So there are types of expert. One is the auditor's expert, in which this is an individual or organization possessing expertise in a field other than accounting or auditing, whose work in that field is issued by the auditor to assist the auditor in obtaining sufficient, appropriate audit evidence. And an auditor's expert may be the auditor's internal or external expert. The second expert is the management expert. This is an individual or organization possessing expertise in a field other than accounting or auditing whose work in that field is used by the entity to assist the entity in preparing the financial statements. Next, reference to the auditor's expert in auditor's report. Reference to the auditor's expert work should not be made in an auditor's report containing an unmodified opinion unless required by law or regulation. If such reference is first, required by law or regulations, or second, relevant to understanding of a modification to the auditor's opinion. And then, the auditor should indicate in the auditor's report that the references does not reduce the auditor's responsibility for the audit opinion. Next, the auditor's responsibility for the audit opinion. The auditor has sole responsibility for the audit opinion expressed, and that responsibility is not reduced by the auditor's use of the work of an auditor's expert. Nonetheless, if the auditor using the work of an auditor's expert, having followed the international standards on auditing, concludes that the work of that expert is inadequate for the auditor's purposes, the auditor may accept that expert's findings or conclusions in the expert's field as appropriate audit evidence. Lastly, when determining the need for an auditor's expert, if an expertise in a field other than accounting or auditing is necessary to obtain sufficient appropriate audit evidence, then the auditor shall determine whether to use the work of an auditor's expert. And that ends my presentation. Thank you for listening.